Well, hello, this is Hall Martin. I'm the CEO of 10 Capital, where we help startups and investors connect for funding. I want to thank you for joining us today for this webinar on Due Diligence 101. We're not going to go into all the details and nuances of due diligence, but talk about it at a high level, both from the investor perspective as well as the startup's perspective. It's an area where many startups come to me and they have a lot of questions about how it works, and almost an equal number of investors coming in trying to figure out how to manage the process. They know they're supposed to do due diligence, but they're not quite sure how to approach it. As if you're not careful, it can become an infinite loop where you're always asking more questions and spending more time on it, and there has to be some bounds on it in order to make it successful. So if you have questions, we have a chat box and a questions box. By all means, drop those in there and we'll do our best to answer them. We should have time at the end to answer everybody's questions, have a few slides to go through that we wanted to share with you before we get to those, so we level set here. So let's go ahead and kick into it, and let's talk about going through due diligence. For a startup that's raising funding, what you want to do is be prepared for the due diligence process and understand diligence will vary widely among the investors. After an investor expresses interest in funding your deal, the first question you should ask is, what is your due diligence process? Well, most processes follow the same format of reviewing the documents, analyzing the data, and asking follow-up questions. Each investor has their own time frame, checklist, documents they look at. And so it's best to follow along their process. And if they have one, ask what that is, and then follow along and adhere to it as opposed to fight it. Having a due diligence box, or what they call a data room, with all the standard documents in there is a great place to start. As you put your pitch deck together, the next thing I would do is put together the data room. This could be in a formalized data room setting, or it could be a Google Drive or someplace where you have a list of the key documents and you also have gathered those documents into one place. If you would like a checklist for due diligence, email me after the webinar, and I'll be glad to share you with our list. It's a complete, comprehensive list, but for startups, I've listed about 10 to 15 documents as must-have. So if you're a startup, start with the must-haves on there to gather those documents first, and it will help you be ready for when an investor comes in. It makes you look prepared. It helps prevent the deal becoming a paper chase. I've had investors walk away from deals not wanting to deal with all the different paper chase that was about to go on. So you want to remove that obstacle if you can as well. Next one is that you want to be careful of when you work with these investors, that sometimes you're working with an investor and sometimes you're working with an analyst. And so you want to be a supportive element, making sure they have the documentation they need. Having done due diligence as an investor, I can tell you the biggest time sink is waiting for more documents. And so when they ask for a document, by all means, speed it up and get the document to the investor, because they need that to finish. And the faster you get them the document, the faster they get to the conclusion and write the check. So next question is what is around signing NDAs. When we go into diligence, that's the time to start thinking about signing what are called non-disclosure agreements. That means you're going to keep all of this information confidential. When I go out and I go through deal flow and I'm seeing pitches for the first time, I'm often puzzled by the startup that comes up to me and says, I'm working in the XYZ field. And then when I start to ask questions, he says, oh, you're going to have to sign a non-disclosure agreement to find out anything else. And typically investors only sign NDAs when they go into diligence. Up front, before that, when you're in pitch mode and you're educating the investor, you need to have some version of your pitch deck and documents available that anybody can go look at. If I hear somebody ask me for an NDA after the first question, what goes through the mind of the investor is that they don't have any protection on this deal, and it's going to be a challenge when you open the doors and start selling the product, because most information now is known, what the product is, does, and so forth. And so don't be asking for NDAs on the first day. Wait till you need to have that. And NDAs are really for truly proprietary information, things like specific clients, contact details of the clients, how trade secrets, how the intellectual property is working, behind the scenes work. And that's fair game to share with investors in the diligence phase, and it's fair game to ask for a non-disclosure agreement. And again, have a non-confidential version of what you of your documents, so you can always share that with them. The technique I always coach on is you don't have to tell the investor how you do everything up front. All you need to do is tell them the benefits of what you're doing. Our software reduces cost by 30%. I don't have to get into how it does it, but the benefit is out there, and that should generate the next meeting, which is the goal of this meeting. So if we go to the next slide, one thing you'll find is that diligence ranges widely. Some investors have a very detailed process, very rigorous process, and others have a very casual, very high-level process. And so one thing you want to think about is be prepared for many kinds of diligence. And in particular, you'll see a difference between angels and venture capital. At a high level, they're both looking for a good team, a strong market, and a quality product. But at a detail level, what I found is the angels who come in earlier than many VCs will look at the deal differently than the VCs. On the first pass, angels look for product validation and market validation. Does the product work, and will someone pay for it? If we're not at that stage, it's going to be hard to get further into it. On the second pass of that deal, the angels will come back and they will start to look for, is the team strong, and can they take it all the way? And is the market large enough that we should pursue this deal? The VCs on the first pass look for a strong team, initial traction, and a large market. Those three things come up very fast. And so you want to be able to have that documentation available for them when they come in. On the second pass, the VCs start looking for things like synergies on the team, KPIs or key performance indicators that show growth and scalability into the market. So when you're pitching and going into diligence, think about who you're pitching and what type of investor they are, as they do approach it differently. The next slide, we're going to talk about the difference in qualitative diligence versus quantitative diligence. I find diligence breaks down into two stages. The quantitative is check marking the boxes to say, yep, they said they had a Delaware C corporation, and yes, I see the Delaware C corporate entity filings here. So they're going through and they're doing the check mark thing to see if what they understand about the deal and what documents in the box prove that out, and if all of it's been proven out. And so there's pretty much it's a quantitative aspect. And then the next one is you get into the qualitative side of diligence. Here, this is where we start to analyze the team. Do they have the experience? We look at the competition. How strong is this deal compared to the competitors that are out there? And we start looking at things, how strong is the communication skills of the CEO? What's the quality of the company's prospects here? And so this is going to take a little bit of more time to go figure out. With quantitative, you can outsource that to an assistant to go through and check mark the boxes and go through the diligence box to see what is there. It is a little bit detailed process. But for the qualitative one, that really should go to the investor. The investor should meet the CEO. They should be comfortable with the CEO's skills and that of the team as you go forward. So you'll see that there's two elements to due diligence, and what goes in the diligence box is primarily the quantitative. But as an investor, you're also going to want to look out to see what are the qualitative metrics being met. So let's go to the next slide. And so in talking with startups, I find the investor, you must always, as an investor, you must always probe for the answer. Never stop at the first answer. Ask 3 to 5 questions more to get to the final answer. And so I have I was talking to a startup the other day who said they were raising $1 million and that they had raised half of it already. And I said, that's great. And so on the surface, I'm thinking, okay, they've got 500K invested in the business today. And so I asked, so that's great. You have 500K in the bank already from your raise? And they replied, well, not exactly. We have several investors telling us they are interested in investing. After several more questions, it came out that they had 100K in the bank and around 300K in soft circle commitments. It's good progress, but it's not exactly the $500,000 in the bank that I was hearing at the beginning. So as an investor, make sure you don't just take the first answer, you probe a little bit to get down to the more detailed answer and take away any misunderstandings or confusions. As I say, it takes at least 5 questions to get to the real answers. And as an investor, you want to know what the real answer is. On the flip side of that, I will encourage startups to answer questions directly. I would say that when I often ask people, what is your revenue? Half the time, the answer I get back is a story. It's a story of how they started the business and how they made their way here. And what I was looking for was, how much revenue have you booked, this month or this year or so far since the inception of the company? And so if they ask you a direct question like, what is your revenue? My recommendation is give a direct answer. If they ask for the story behind it, well, then give them the story. You'll often find that investors, especially in diligence, are short on time. I had a startup that had an investor on the phone, and it turned out they only had 10 minutes left, but they had 20 questions, and the startup was trying to give a story on every answer. What is your revenue? Well, let me tell you the story of our revenue cycle. What is it? Tell me about the team. Well, let me tell you how I hired the people. But that's not what the investor was looking for. They were looking for the short to the point answer because they had to fill out all 20 questions on the questionnaire in a short amount of time. So always answer short and direct up front, and then later expound upon it if they want to know. So that's the topic there. Let's go to the next slide. And so startups who find an investor expressing interest often stop their fundraise. I get this a lot. I'll hear from a startup that they've got an investor that's coming in and they think it's going to be big. And if they do come in with all the money, well, then they will have raised their round. So they stop looking for funding elsewhere. They stop communicating with the other investors that they have lined up. And I always say this is a mistake. You should always keep updating investors and communicating with all investors until the check clears the bank. I've seen deals blow up on the 1 yard line where we get all the way down to it 6 months later, and we just can't agree upon terms. Terms change, the deals change, something's different, and so the whole thing that investor goes away, and they have to go back to those investors that they disconnected with 3 months earlier and try to re-engage them into the deal. I always say keep those investors online, keep them up to date with how it's going, and carry it along until you get to the right answer with the investor. So make sure you don't stop your fundraise and your diligence process in between. Keep it going all the way through. So the next slide before we get to Q&A is key documents. So we talked about the diligence box a moment ago, and as an example of what you put into yours, and we have a more complete list if you like it, is number one, entity filings, your LLC or your C corporation filings and your articles of incorporation, whatever those are, let's put those in the box. Patent filings, if you have provisional patents or awarded patents or filed patents of any kind, go ahead and put them in there. And what investors want to know is what was filed and when. They want to know, is it a provisional or is it a design? Is it utility? Patents take 3.5 years to reach maturity and be awarded or not. And so nobody's expecting the patents to be awarded, but they do want to know how far along they are in that process. Then there's income statement and balance sheet. These are historical financial numbers. People want to know, do you have debt? What kind of revenue have you booked? And they really want to see something done by a professional accountant or a bookkeeper, not just a spreadsheet. So if you can get that, that's great. And then a 3 to 5 year financial projections. Again, getting a good quality financial projection gives the investor confidence that you know what you plan to do with the money. Good financial projections demonstrates you know your business. Sometimes I'll see financial projections and everything is rounded off to the nearest $1 million. And that tells me that we really don't know what we're going to sell. We don't know what our price of our product is. And so that's a bit of a problem. I'm really looking for a little more detail to demonstrate we know our business. And finally, the cap table. Cap table is the list of equity owners and who owns what in the ownership of the business. And this is important to investors. So make sure you have that available for them as well. So there are other documents you can put in there. And technically anything that's relevant to the business. If you have lawsuits, if you have multiple products, you want to put by product breakdowns in there. If you have multiple customers, you want to show by customer breakdowns, and what investors are looking for is customer concentration issues. 90% of your revenue is coming from one customer. That will be an issue for them. So as you get bigger and go further, when you have tax returns and other documents, you'll want to put those in there as well. And then if they have a checklist where they require additional documents, it's good to go ahead and put those in there also. So at this point, let's check to see if we have any questions from the chat from you guys in here so far. And at this point, we have a couple of questions that we want to answer for it. The first is, I'd be interested to hear what you have to say about avoiding infringement of patents and trademarks as a part of the due diligence process. So as an investor, when you come in, what you need to do is check to see if they have a process for, have they gone to the attorney to get what we call a freedom to operate ruling. An attorney has gone through, checked your proposed patents, checked your product, checked other people's patents, and they've come up with a ruling or a recommendation that, yes, you are free and clear of any other patents that are out there. If you're in a place or a space where there's a lot of patents that have already been filed, it may be worth the money to go up front before you go too far down that path to make sure you have a freedom to operate and you're not infringing on somebody else's patents and trademarks. You've done trademark searches, you've done patent searches, and you're free and clear to go and carry forward with it. The other side of that is a typical patent strategy for a startup is to line up three to five provisional patents. Provisional patents are not very expensive. They're very short, straightforward to write. Again, I'd probably get a patent attorney. I wouldn't do it myself because there's a lot of nuance that goes into setting those things up properly. And in that ensuing year, you have 1 year to make a decision to carry that patent forward and turn it into a full patent, or you can drop it. My recommendation is you spend the year testing the market and doing research to figure out what patents are really going to serve you well. You keep those and turn those into full patents, and the others you let go. But you now have a time when you're actually looking at the technology, trying to figure out if any of those can actually give you patents. If you're planning to file patents, do so before you go out to do fundraise. I would say half the value of a patent in the early stage is not to protect the business, but to convince the investor you have quality technology, you have a proprietary method that is going to add value to the business. So make sure you put those in there, and in your slides show you had patent pending technology. You filed and you're on your way towards it as well. We have a quick poll there if you'd like to take that. Love to get your thoughts on there as well. And then the second question I have is, I'm a small coffee shop owner that closed due to the pandemic. I bought a robot and programmed it to be an automated barista. I just opened the first robot coffee shop in Colorado, and I'd love to get this in the hands of small coffee shops around the globe and save as many small businesses as possible. Starting to look for partners and investors, but having a hard time figuring out how the best metrics show traction. And the majority of our leads are interested in robots as a service. However, I don't have the funds to get that off the ground. But it seems to me investors want to see conversions. How can I show my wait list as serious traction? And I have a couple of thoughts there. Number one is, if you have a strong wait list of customers for your product, let's say the robot costs $10,000, I would ask each of the waitlist people to reserve your spot on the list. You have to put up 10 to 15% as a down payment on it. And I would put that in an escrow account. You have an attorney that can draw up the documents for that. The attorney can put it into their account. They can be the third party fiduciary. You don't have to go to a bank and get a trust account or anything. Just have the attorney draw it up, and once if it doesn't go forward, they get their money back. If it goes forward, you apply the 10 to 15% down payment to their purchase. And this is like Kickstarter, where people are prepaying for the product. In this case, they're not paying for the whole thing, they're just paying a portion of it. And that's what investors are going to look for, is that there's some skin in the game. There's somebody putting money on the table to have this. That's going to stand out a whole lot more than somebody that just signed up on a list on the website because they thought it was a cool idea. The second thing you can do is go out and raise the money with family and friends and sell, say, 5, 10 units, something in that ballpark, very low, and then calculate the unit economics of that experience. With early stage companies, we deal a lot with people that have very modest traction. But I tell them, if you have 5 to 10 customers, what you want to do is analyze those customers and figure out what was the cost to acquire them, what was the cost to deliver it to them, what was the average selling price, and start to develop at a unit economic level the story that this is a working business, albeit a small one, and here are the numbers to prove it. And we can turn this into a repeatable process by continuing to do the same thing before, and with money, we can actually carry it to be much bigger. Because investors are not looking for big money at this stage. What they're looking for is repeatable, predictable money. And if you can do that at the small level, 5 or 10 units, this is going to be compelling to some investors to know, yep, you can do this, and it's moving forward. So let's see what other questions we have here. So what is the standard protocol that investors do for running background checks on founders? So this varies widely. Some investors go out and find online services to run a background check. They range anywhere from $70 to $2,000, depending upon how much detail you're looking for. And fundamentally, what they're looking for is, are there liens against the business already, tax liens, and have there been bankruptcies in the past, and have there been any criminal activity? And many of the lower cost ones will tell you that information. Many attorneys use a tool called LexisNexis, where they can actually look up a lot of that information and share it as well. So you'll see many people using that tool to try to figure out. I have used that tool myself, and from time to time, I've actually found that tool to be mistaken, and they had to go change the records because the person didn't have the criminal background it said it has. So sometimes there are mistakes in it, but good due diligence process is going to check into the background of the people and the history of the company to understand where it's been. Next question is, what are the benefits of entering into an incredibly detailed letter of intent to purchase my company? How can I go about pushing back against certain fundamental provisions without pushing the acquirer away? Well, the key there is to not throw the entire letter of intent away, but to soften some of the terms. Sometimes they'll have onerous terms in there, like no shop clauses for 6 months. Well, let's make that a no shop clause for 30 days. Sometimes they'll have escrow accounts for 6 months. Well, let's make that an escrow account for 2 months. And so soften some of the provisions. It may be hard to remove them entirely, but to move them back a little bit is usually a negotiation that investors will take as well. And then if they have very specific things they want to do in those timeframes, give assurance that you will provide documentation and other things that they can do their work in the time you want to put in there. If you have more questions than that, let's catch up afterwards to see what other specific provisions may be the challenge there. But usually it's negotiable. These term sheets are, in some ways, they look boilerplate, but if you get down to it, they can be changed, and many will at that level. And so next question is, what do you look for in a startup team? So the thing I'm looking for is completeness. I'm looking for someone building it and someone selling it. No fair, everyone's building it and no one is selling it. So in a software company, yes, you have a lot of developers, and it can be that we're all trying to build it, but I'm looking for the person who is selling it and they want to sell it and they're good at selling it. And that's a key thing that is often lacking from tech teams that go out there. And then likewise, consumer product goods. I find people are very good about making the product, building the product, manufacturing the product, but they're not very good about going out and selling it, which is basically lining up distribution channels and running e-commerce platforms. So I'm looking for completeness in a startup team. And as the team grows, that will change, but at the very early stages, one person's building it and the other person is selling it, and in equal amounts. Next question is, how soon would an interested investor want to start diligence? My experience is it takes about 4 touches before the investor knows what you're really doing and fully understands it. It then takes another 3 touches before they make a decision. Yep, I think I want to invest. And so it takes 7 touches to close the sale. So it's going to take 7 touches to bring an investor to that point. And somewhere in the 5th or 6th or 7th touch, the diligence process starts. And so you have to think along the lines that they're peeling back layers of the onion, and they have to peel back enough layers. In my case, 4 is the number, before they feel like, yeah, I feel like I really understand what's going on here. And only then are they going to make that decision to go forward, and at that point start diligence. And so you really can't rush it. What you need to do is just find ways to get more touch points and more education going along to educate them about the deal. And in some cases, you will be reminding them of things that you've already talked about. Realize investors look at a lot of deals. I look at 20 to 30 a day. And so I sometimes have to be reminded as to where exactly we are with this one. And so be prepared to do some repetition there as well. So I don't see any more questions. If you have any more, go ahead and pop them in there. And like I say, if you're interested in our due diligence checklist, just drop us an email and we'll share that with you. And you can get a Google Drive account. There's many other accounts out there. Nightly has a nice account for data room services. If you like a contact with Nightly, we'll be glad to recommend you to them. And you can look at theirs at very low cost, but it's a nice place to put your documents. And that makes a difference to investors when you show up and you have a data room already built. The documents are in there. They look nicely placed. It looks a whole lot better than when you're just sending one document at a time across the email, which we get a lot of the times, and it doesn't look so good. So with due diligence, we have an e-guide on this topic. Glad to share with you as well. If you have any more questions, feel free to follow up with us after the webinar. And with that, we'll go ahead and close it from there.